Today we're doing a review on St George Bank and their home loan, the good, the bad and the ugly.
Now depending where you live, St George Bank is also known as Bank of Melbourne in Melbourne and Bank of SA if you live in South Australia. But it's all the same bank, just different labels. Well Nados, let's jump right in. So St George is a fairly competitive retail bank that is based around Australia. They offer home loans, term deposits, savings accounts, the whole kit and caboodle. You might have even seen their branches around. They've got the little dragon that sort of helps out.
And whilst they're owned by Australia's second largest bank, which is Westpac, they are run completely independent of each other. So they've got their own policies and procedures and credit criteria that needs to be met. So today we're going to jump right in and look at the 3 things that St George do really well from a home loan perspective and 3 things that they don't do so well.
All right, Nados, number 1 they're great at is if you're buying your first home and you don't have a big deposit. So why are they so good at low deposit loans?
They are fantastic at low deposit home loans, lending up to 95% of the property value. Some lenders have a requirement for what's called as genuine savings. Now this is where the bank needs to see a savings pattern for usually 3 months to show that you've got skin in the game, you've saved up your deposit. The good thing with St George is you can actually show your rental history. So they'll look at the last 6 months. If you've been renting through a licensed real estate agent and it's all been good conduct, they actually don't need to see any savings history.
So where this works really well is you might have been gifted a deposit from your parents to buy a property. Now a lot of banks would want to see that gift sitting in your account for 3 months, pretty much gathering dust, and show it as genuine savings to show that you can hold on the money and not going to spend it. St George, on the other hand, like Nathan said, would accept your rental history to show, hey, actually you've been paying rent for the last 6 or 12 months, and while you've been given the deposit from your parents, they're happy to accept it and potentially lend you up to that 95% loan amount.
The other thing that's quite good is if you're receiving the first homeowner's grant, that can be included towards your deposit and not needing to show any genuine savings. So this is an area that we see St George do exceptionally well and gets people into the market where they might be struggling elsewhere.
All right, now, so point number 2, if you've got a no deposit loan. So if you're getting the help of a guarantor, why is St George better than the rest when it comes to guarantor home loans?
Their guarantor home loan is best in market by far based on what I see, for a number of reasons. Number 1, the guarantor can be working or retired. This is a niche in itself. A lot of lenders want to see the guarantor working, where St George actually don't need to see that. The other thing the bank will do is they'll allow you to do a guarantee on the guarantor's primary residence. So once again, another niche where a lot of lenders will not like to put the guarantee on the primary residence of the guarantor. And the last thing that's pretty good with their no deposit family pledge is that you can lend up to 105% of the property value.
So in other words, if your parents are willing to go as guarantor, some banks won't actually accept a guarantee from a home they live in. They'll want it to be an investment property or something else because they're worried if you stop paying your loan, you have to kick them out in the street and they're going to lose their property. The other issue some other banks have, like Nathan said, is if your parents are retired and they're not working. There are other banks that will simply refuse to use a guarantor or guarantee from their property, whereas St George are tick, they're all completely fine with that. So like Nathan said, they're amazing if you're looking at borrowing 105%, maybe you need some help with stamp duty, or if your parents are retired, or if you're getting a guarantee from your parents and it's on the house they live in. Tick, good work, St George. So the third thing St George are awesome at is bridging loans. So a bridging loan is used when you're looking at upgrading your property, you've got one home that you haven't quite sold and you want to buy a new one without having to sell them all at the same time. So Nathan, I guess, tell us a bit more. Why is St George really good at giving bridging home loans?
That's right. St George are great at bridging finance, and mainly for the fact that number 1, they look at when you've got your existing home, which you're going to sell, and the home that you're buying and the combined debt. They actually don't look at it as if you've got to repay that debt. They allow you to add the interest that is combined being charged on these loans on top of the loan each month until you sell this property, which you do have 12 months for, and it's gone. Then the bank looks at the end result of the finance left over.
So in other words, if you're buying a property and you haven't quite sold the one that you've sold, the bank's not going to make you make repayments on that huge debt that you're going to have because potentially going to be selling this place in the next while. they'll add it onto the loan, which makes it a bit easier to manage your cash flow. And like Nathan said, that's something really unique that only St. George Bank offer.
So in other words, when we look at it in the market as compared to other lenders, a lot of the other banks will look at when you've got both properties over the bridge, that how you can make the repayments for the peak debt, the highest debt that you're going to be locked in for. Whereas St. George, as we said before, they don't look at that. They'll just keep allowing you to add the interest on top of the loan until you sell and clear out the debt. So that's the third thing that we think St. George do really well. So we've looked at the 3 things St. George do exceptionally well at. Now we're going to look at the 3 things that St. George don't do so well at. So Jayden, what's the first thing here that you see that St. George probably aren't so good compared to the market?
Yeah, so one thing St. George really struggle with is units or apartments, and in particular, specific apartments. Now, St. George are quite unique. They actually have a blacklist. So they have a list of apartments that they just simply will not lend on. And there's other apartments they list in there that they have limitations on. Now, as we've covered in other videos, some banks have postcode restrictions, other banks have restrictions based on types of properties. St. George just go, I guess, a step further, and they'll have specific unit complexes that they list in this report based on the address or based on the complex. And because they might have lent to too many people in that one building, or because they might just not like the developer of that building, they just won't lend on it. So it's one thing to be aware of is St. George's apartment blacklist. All right, Nathan, so number 2 that St. George kind of struggle with is if you haven't been in your job for a very long time. So tell us a bit more about that. How does it work?
So this is mainly around when you have a minimal deposit, less than 20%, the bank will actually need you in your role for more than 6 months. If you're new to the industry, or if you're consistent in the industry, they need to see 2 years of consistency. So what that means, practically speaking, is if you have less than a 20% deposit and you're going for a St. George loan and you've only been in your role for 3 months, unless you can show 2 years worth of consistency in the same role, same industry, the bank's not really going to be open to assisting.
So just be mindful, if you've just recently started a job or if you've been there less than 6 months, St. George Bank might not be the one for you. All right, Nathan, the third thing that St. George aren't great at is lender's mortgage insurance and the fact that it can cost a bit more, right?
That's exactly right. Now, when we compare lender's mortgage insurance in the market with lender to lender, St. George's lender's mortgage insurance tends to be a little on the high side. So that's a drawback that we see when comparing lenders with lenders. St. George's lender's mortgage insurance can sometimes be a little bit more expensive depending on the lend that you've got and the ratios you're sitting in at. So that's it for today, guys. Please like and subscribe. If you have any comments, please leave them in the comments below. And as always, thanks for watching.